Have you ever stopped to think about how massive companies, or even entire governments, borrow the billions, sometimes trillions of dollars they need to operate? Well, the answer comes down to a surprisingly straightforward concept: the bond. It's really the engine of global finance, and today we're going to pop the hood and see exactly how it works.
So let's kick things off with a little riddle. What could you possibly have in common with a tech giant, or say, the US government? It's got nothing to do with size or power. Nope, it's about a single fundamental financial need that pretty much everyone shares.
That's it. You all borrow money. You might take out a loan for a car, they might borrow to build a new factory or fund public projects. A bond is just a formalized, tradable version of that very same idea. It's basically an IOU that's been scaled up for the whole world to buy and sell.
All right, so here's our roadmap for this explainer. First, we'll get a handle on what a bond really is. Then, we're going to break it down into its essential parts. After that, we'll look at the different flavors they come in, figure out who gets paid first if things go south, and finally, we'll unpack the legal contract that holds this whole thing together.
You know, at its core, a bond is just a loan. Simple as that. But here's the game-changing difference. Unlike a simple IOU between two people, a bond is a standardized financial tool, built specifically to be bought and sold by thousands of investors all over the globe.
Okay, so the official term you'll hear is a fixed income security. It sounds complicated, but it's not. The issuer is just the one borrowing the money, and the investors, that could be you, me, or a huge pension fund, are the ones lending it. And that fixed income part, that's the big promise. A predictable, steady stream of interest payments, plus your original loan paid back at the end. That predictability is exactly why people love bonds.
So, if a bond is basically a contract, what's actually in the fine print? Well, it turns out that every single bond, no matter how complex it seems, is built from just a few key pieces of information. Let's take a look at its DNA.
First up, you've got the par value. The easiest way to think about this is like the face value of the loan. It's the amount, usually something like $1,000, that the issuer promises to pay you back in full when the bond matures, which is just a fancy way of saying when the loan is due.
And next, we have the coupon rate. This is just the interest rate. So if the par value is how much you lent, the coupon rate is kind of like the rent the borrower pays you for getting to use your money. It's always shown as a percentage of that par value.
So how does this actually turn into cash in your pocket? Let's walk through a quick example. Let's say you have a bond with a $100 par value and a 6% coupon. Well, you just multiply those, which gives you $6 of interest for the whole year. Now, if the bond pays out quarterly, you just divide that $6 by 4, and there you have it. You get a payment of $1.50 every 3 months, just like clockwork. It's that super reliable income that investors are looking for.
But hold on, does every single bond pay interest in that same simple fixed way? Oh, definitely not. There are a few major branches on the bond family tree, and each one has a different way of handling those interest payments.
You've really got three main flavors. The fixed coupon bond is the classic we just talked about, predictable, steady payments. Then you've got the floating rate note, which is a bit more dynamic. Its payments actually change over time, adjusting to what's happening with interest rates in the wider market. And finally, there's the zero coupon bond. This one's kind of weird. It pays no regular interest at all. Instead, you buy it at a really deep discount. Say you pay $800 for a bond that's worth $1,000, and your entire profit is that $200 difference you get back at the very end.
Okay, so with any loan, there's always a risk, right? What happens if the company you lent all that money to suddenly goes bankrupt? Well, not all lenders are treated equally. There's actually a very strict pecking order for who gets their money back, and understanding your place in that line is absolutely crucial.
See, it all comes down to priority. Right at the front of the line, you have senior secured debt. These loans are backed by specific company assets, what we call collateral. They get paid first, no matter what. After them, you've got senior unsecured debt. And then, way at the back of the line, hoping for whatever scraps are left, is the junior debt. As you can imagine, the further back you are, the higher the risk, which is why you'll typically get a higher interest rate to compensate you for taking that chance.
So we've talked about all these promises about payments, about your place in line, but what actually forces the borrower to keep their word? This isn't just based on a handshake. All of these details are locked down tight in a formal, legally binding rulebook. This master contract is called the indenture. You can think of it as the ultimate source of truth for the bond. It lays out every single feature, term, and obligation. And most importantly, it contains a set of very specific rules the borrower has to live by. These rules are called covenants.
Covenants are really just the do's and don'ts of the loan agreement. Affirmative covenants are the things the issuer must do, like making payments on time or providing regular financial statements. Then you have the negative covenants, which are all the things the issuer cannot do, like they can't suddenly take on a mountain of new debt or sell off the key assets that generate all their income. Both types of rules have the same goal, to protect you, the lender.
All right, let's pull all these pieces together. What's the big picture? A bond is just a formal tradable loan. Its basic features are its par value and its coupon rate. We've seen that they can pay out in a few different ways, and we know that your seniority, your place in the repayment line, is a huge part of your risk. And this whole agreement is held together by the indenture, which is that all-important legal rulebook.
Which really brings us to the big question, right? Now that you know all the rules of the game, the interest rate, the risk of getting your money back, all those legal protections, how does all of that affect the price you're actually willing to pay for that bond today? That is where the real art and science of finance begins. Something to think about.